Good morning, good afternoon. Welcome to Develop Your Edge with Anthony Crudele. I'll be the co-host, Tom Schneider, CMT with NinjaTrader. Before we get into the good stuff, I do want to remind everybody that futures and options trading is not for everybody. It contains substantial risk. You could potentially lose all or even more than all of your initial investment. That's why we recommend use risk capital. What is risk capital? It's money you can afford to lose. It doesn't keep you up at night. It doesn't extend your retirement horizon. I also want to remind everybody that past performance is not necessarily indicative of future results. What we talk about here on this presentation contains neither trade recommendations nor financial advice and should be used only for educational purposes. And with that out of the way, it's my pleasure to welcome back to the show Anthony Crudele. Anthony, how you doing today?
I'm doing great, Tom. How are you, and how's everybody doing out there today?
Oh yeah, everybody seems to be doing good out here in NinjaTrader land. Beautiful day out here in Long Island. I know you're back at home. A little bit different office though today.
Yeah, getting some work done to the studio. Hopefully, going to be releasing my whole new big studio for all the podcasts that I do at the end of this year. So, getting a little work done there, and hopefully, I'll be back in there next week. But not the launch of the new studio until probably end of the year. But I'm looking forward to that.
Yeah, it'll be exciting. I saw your studio when I visited back. I think in March it was, and it was pretty impressive then. So I can't wait to see the changes.
Yeah, I'm excited to get it done. And we're actually is an exciting day to talk about gold. We're going to talk about today, and I kind of want to jump right into it because I know markets are busy, and I know everyone probably is looking at equities. And at the beginning of the week, I actually did a video where I talked about gold and why I said that was my favorite trade to the short side. And lo and behold, here we are today with gold. I think is really taking center stage over equities at this current moment because I think equities trend was pretty much already intact. We already knew that Nasdaq was leader to the upside, S&P kind of in the middle, while you had Russell lagging, and you just had this kind of really quiet bull market type environment, very range bound, mostly in S&P, while Nasdaq's breaking out, and everybody gets so focused on that and it gets so choppy. And I said even at the beginning of the month, that's not the market I'm really going to be focusing on. I'm going to be waiting to see what happens. And I think the one thing I want to talk about as futures traders and developing your edge is that don't always be so hyper focused on one product. I mean, initially in my career, and I think for a lot of new traders, it's important to look at one product. But I think that once you get the sense of and the feel of what it's like to trade futures and you have a strategy that you like, you're going to go through cycles where sometimes everything's going to work. And I say this all the time on Twitter, everything works sometimes, nothing works all the time. And you get in these cycles, you get in these market environments where I think where we've been in equities for at least the last few weeks, maybe longer, is really the sideways to up. And it makes it kind of difficult in the intraday for the intraday trader. And it's just not the best environment maybe for some strategies. And for other people, it might be the best environment. Once again, it's just dependent. Look at these other markets, these other major markets. There's still a ton of liquidity in markets like gold, oil, natural gas, although that one I kind of a little, that one's a little tougher for me at least. But there are other markets and they go through these cycles where all of a sudden you start to see things work really well on your strategy. And you're moving into that market where maybe you're not totally comfortable with it. Maybe the movement in gold's a little bit different than you're used to in NASDAQ or S&P, but the look is very similar. And over the years, I've learned to transition from market to market based on the environments. And I want to talk about why I've been really pounding the table on gold being short because of not what we're going to see on the charts necessarily, but what leads up to certain moments and cycles. What is gold typically used for? What does everybody really talk about when we talk about gold? We talk about gold as a hedge against central banks, a hedge against inflation, right? And so if you go back where inflation was transitory, then it wasn't transitory, gold and Bitcoin started to take off and they really started to go up, and they were actually going up with equities if you go back and look at the chart of it, right? And a lot of people were putting gold into their portfolios. People were going to gold futures to have that hedge against central banks. How far are we going to go? What's going to happen? And then ultimately you have this move that really takes place that it's kind of Captain Obvious that gold should have started to rally when it did. And although it was probably not the easiest trade, we all understood what happened. Then we take us to current day. And you go back to look at the beginning of May, and I'm going to go to the charts when we get to this because this is where the charts start to come into play. You think about when that cycle was, right? Everything you guys all have heard, buy the rumor, sell the news, right? And a lot of times when you have these cycles, it's weird. It's almost like a switch where all of a sudden the Fed on May 2nd to 3rd meeting raises that last quarter point. You look at gold, it goes up, it makes a higher high the next day, and it just comes right back off. I saw it pierce the Bollinger Bands, and I looked at it and I said, is that the move that just changed the tone of this market? And sometimes towards the end of something that we were leading up to, it just happens. And you don't know if it's happening or if it did happen, but you watch these things so much where you're kind of like, everything's getting quiet now in equities, right? You look at the Fed fund futures, the SOFR futures. Are they done raising rates? Is inflation really coming down? Has the Fed won? And then you look back and you say to yourself, and you look at this environment and you say, what is the most crowded trade if the environment changed? Well, if inflation's done, does that mean that stocks all of a sudden are going to start going down? Probably not, right? If anything, it helps stocks. If you look at what's happened in gold and Bitcoin, maybe, just maybe, when you look at those markets, maybe technicals are lined up and said, maybe we've found a top here. And maybe the people that have been long looking for that exponential move to the upside just doesn't come. One of the things that I've learned in my lifetime as a trader is when you are towards the end of cycles and when you are towards the end of something that we've been leading up to, the market positioning is usually at its near its max. And I know a lot of people were talking about COT data for gold and stuff. I haven't actually looked at that. I don't look at that normally, but I know a lot of people were actually tweeting me about that. When the positioning all of a sudden starts to get really frothy towards that end, and now everyone's sitting there waiting for that last bit of move to happen in a market, and a slowly but surely just starts to unwind because all the weak hands start coming out. And one of the things that you always look for is where people are wrong is where you're going to get a sharp move the quickest, right? Nobody wants to be the last one out of gold right now. So if you start to see technical breakdowns, although everyone may believe that gold was the trade to be in, all of a sudden they are now getting challenged with that idea because we're at the end of a cycle, potentially in a new one, and you're also in a situation where technically we're starting to break down. And when those two things start to happen, look out, and it could go for a lot longer than you think. And so, Tom, I want to bring you in, and I just want to talk about, and the reason why I wanted to bring all that context to it first is a lot of my trade ideas come from a situation where I'm like, what's just happening out there, right? I don't need to look at a chart to kind of know. And then you look at it and you kind of put that puzzle back together.
Yeah, I mean, gold is such an interesting trading vehicle because it is truly global, and it is something that is affected by everywhere in the world. Their central banks are using gold to hedge, and one of the things that I've been looking at is how much they've stopped, or not how much, since 2007, central banks have been buying gold and increasing their buys, and just recently they're coming off, right, which kind of aligns with what you said. The inflation picture is kind of changing, and you can see that in the chart. I'm looking at the chart. I've been looking at the chart the whole time you've been talking, and it just resonates how that chart reflects exactly what you said fundamentally on a technical view. You can see it plain as day if you know what you're looking for. But I agree, sometimes you can't just look at the charts. Sometimes you have to anticipate what's happening, understanding the playing field, if you will, from a fundamental or structural point of view.
People have to remember that It's still people behind the chart. And gold has been, if you go back and look since the end of last year, and if we have the chart up right now, everyone can see it. And I drew this just a simple trend line. And everyone knows I'm not typically the trend line drawer. You have a situation in gold where gold has been in the in trade, the cool trade for some time. And positioning always continues to grow. Higher prices bring in more buyers, right? Lower prices bring in more sellers. But if you think about that and you think about when things really started to heat up, when we talk about a hedge against central banks, a hedge against inflation, and I'm not saying that hedge against central banks is totally done yet, and I'm not the macro guy to make that claim. The point of it is as a trader, when you look at develop your edge, think outside the box. No great ideas ever come from thinking inside the box as a trader. They all come from thinking outside of the box. And sometimes we lay there at night. I think about my golf swing. I think about, a lot of things. And I think about what's happening in the marketplace. And sometimes it's when there's nothing going on and I'm just sitting back thinking, I sit down and I go, let me take a look at this. And not that I'm trying to curve fit it and basically try to find a reason to validate my idea. I tried to find reasons actually to say this idea is wrong in gold. Why would you want to be short gold now, Anthony? And I started to look at it, and here we are with the charts. And this is really, and it's funny as we can just continue to sell off here in gold, and I think that's going to continue, and I'll explain why when we look at the technicals. But let's go back. Here's what I have today. So I have the Bollinger Bands, 20 period, 3 standard deviation Bollinger Bands, updating on every tick. Okay, everybody, 23 each tick, no middle Bollinger Band. Okay, don't need it, don't want it, don't use it. I have my order flow anchored VWAP. We talk about this all the time. It's my favorite thing. I use this in place of a moving average. I use this in place of a middle Bollinger Band. I use this in place of all that because it's the volume weighted average price. And that's what I like. I also have the RSI. I have a daily chart up here. And look at gold, pounding the table to the upside, knocking on that. I drew a horizontal line at that 70. This is a traditional RSI, plus 70 or greater is always overbought, right? And in bull markets, you want to see markets continue to stay overbought, and they can stay overbought for long periods of time. And when you go back and you look at gold, it just was overbought, but the trend stayed higher, right? And the one thing that we did see in the past that we did not see as of late, and this is where I started to trigger some ideas. If you go back and look back November, December last year, overbought, came off a little bit, grind higher with the Bollinger Bands, overbought again, higher high, overbought again. Decent pullback, comes back, makes this trend, starts to rally back up, makes a new high, overbought again, right here. Then you go back to these last 3 highs, right? And let's actually just go from this point here to there. And what's interesting about that is you have a divergence. You have higher highs, and you have divergence in the RSI. You also have the first time back on May 4th, I believe it is. May the 4th be with you on that day. We violated the top Bollinger Band. You don't see that often. 3 standard deviation move. I know it was a sideways Bollinger Band, not that big of a deal, but nonetheless, semi-capitulation, right? And it comes right back in it, closes in it, next day's lower. And you say to yourself, look at that RSI. You take context of situation, you look at technicals. Everybody at the end is trying to push for this market to do its little bit more, that exponential move. How far can it go, right? And it doesn't happen. And it just keeps getting pulled back in. And ultimately, you start to see the technicals start to shrug off that bullishness. And everyone starts to look and go, wow, we can't get back above a VWAP. Bollinger Bands are starting to open up. Remember, Bollinger Bands are a great tool. When we open the mouth of the Bollinger Band, it's expansion of volatility. When Bollinger Bands are sideways and we're just staying in between them, that tells you that we're very range bound. And so therefore, when you have a daily Bollinger Band really range bound and all of a sudden it starts to open up like a mouth, it tells you that what? Volatility is increasing. That is especially important when you're looking at a trend reversal or a trend continuation for that matter. And now you have Bollinger Bands opening up, staying below VWAPs. You have all these things that are pointing to, hey, this market has changed. And
I yeah, I was just going to say this to me, you probably picked a perfect, there's nothing perfect, but they're close to perfect RSI divergence that I've ever seen, probably in the last couple of years, where combined with that Bollinger failure, that piercing of a tight market Bollinger Band, it couldn't even stay above that. That to me is I think you are understating that failure there. I see it as a technician. I see it as glaring.
as a CMT, right? And
Right.
so think about this, everybody, and I'm going to explain this in I think the simplest way. Imagine you punching a bag or punching something, right? And instead of you punching it and getting further into the bag and moving something further back to show strength, instead it's pushing on you. So your push to go higher is actually fought with more resistance. So instead of you beating down something and expanding, it's actually contracting against you. So what happens is with an RSI, the RSI is saying, that's all you've got, man. You're not overbought. And when you made this other high, yeah, wow, you were strong. I was kind of scared of you. And then it keeps going up. It's not happening. But this is, and here's what I want to say real quick about this, because I actually want to pick your brain about this, Tom. I think it's important. Tom is going to explain more about this divergence, but the one thing that I will say is that what I have seen is that this is the area that gets most traders in trouble. They keep seeing divergence and they keep trying to short it. So what I look at is I don't look at the RSI as just like, okay, I want to be shorted now. I look at it as it's proving to me that in the context of this situation, the RSI is confirming my idea that gold might be at the end. It doesn't mean it's a straight short. You have to wait so much longer to actually, I think, tactically trade an RSI overbought situation, like to where now you go back and look and go, oh, wow, that looks great. And I don't want to tell you that I've been shorting this whole time because I haven't. The point of it is that to me, that's where most people get in trouble. And you have to recognize that when the RSI starts getting divergent, especially at the end of a trend in a bull or bear market, that could take weeks or months before it eventually works its way out. It's not like, don't look at the first divergence and say, oh, it's time to be short. And Tom, that's why I want to go to you from the CMT side. I think this is kind of an important moment. When you see this, what is like the best way to execute, or how does a technician look at this and say to somebody, this is how you probably want to go about trading this?
Right. So that's a great question. The RSI to me is not a trigger, right? It's a state. So there are several ways you can do that. One is the actual value. Two is where it is relative to the overbought, oversold, above 70 in this case when we're uptrending. And then of course divergence when it's not, when RSI doesn't support the price, right? Price is making new highs. Our highs aren't higher than the previous highs in the RSI. So where do you trade it is a great thing. To me, it's almost like a setup or a bias. So I see this uptrend. You've put those trend lines in, perfectly, right? And you see the uptrend going into it. You could see that we kind of kept going, not quite as high, but if you look at April, there were two highs on the RSI that were divergent, but the market kept going up. And so to me, it's okay. Well, now I've got a mindset of this trend isn't as strong as I think it is. And eventually it could weaken. What are my other indications? This is a probability thing, right? Not a trigger, but this is setting the stage for, okay, so I'm thinking this is weaker. What are my other indications? Now you use VWAP on the monthly, so it could be a cross below VWAP. The Bollinger Bands were tightening, so I'm not thinking that we're directional. I want to look for something outside of those Bollinger Bands. We got it, but we didn't close above it, right? So there's failure there. And if you use Bollinger Bands and happen to use the moving average, it might be a cross below the moving average, right? That might be a trigger that says, okay, if we're going up, we should be at the top end of the Bollinger Bands. We're not. We're in the middle or we're trending down. So it really depends on some other indication that says, okay, the momentum is no longer there. The trend of is no longer going to be at some point up. What are my indications? Could be a cross of the VWAP bands on your chart. Could be this opening of the Bollinger Bands and trending downward. We're trending toward, that's a really strong bearish indication. So it might be when those bands open up and we're trending downward. So there are different ways. It really depends on the trader what that signal might be. But to me, that divergence is, like you said, we don't take the first divergence we see. We want to get into that mindset of, okay, this trend is possibly stalling. Let's look for another indication to say, yeah, this trend is changing.
And you and I have discussed this many times on this show. This is why you don't have redundant indicators. You have other indicators, right? We have momentum indicators. We have VWAPs. You could have a moving average. You have different indicators that indicate different things. This way you don't become redundant in what you're looking at. And all of a sudden, when you have redundancy and an upward trend and a divergence, and you keep seeing divergence, it's all it triggers to you is wanting to be short versus a confirmation indicator from something else like a VWAP or a Bollinger Band. It's extremely important because I've been there, and that's where you just get crushed trying to short gold in that situation. And then the next thing I want to talk about is, before I go to the 60-minute chart, and is, so I have a horizontal line drawn there, and it's not, I didn't just draw that line there because I'm like, hey, let me just, this is where I think they're going. This is pretty cool. This is something that I look at a lot, and I call it unfinished business. If you go back and look at this point, in the trend line. See it when it hit the trend line right here, right? I drew the trend from there to there, and you had, this is the moment where the market rallied. Okay, everybody? The market rallied right here, and then you say to yourself, okay, market took off, the volume weighted average price can never get up, and then and I call it really the handoff. I learned that from Brian Shannon. He'll look at the handoff from month to month, or from one critical point to the next critical point. And you have the next month of April where the VWAP was up here. We've just been trading around it. And the new month of May, the VWAP was here. So then what I do is I go back and say that volume weighted average price comes in roughly at 1942. That is where the market built up volume in this month. That's where that volume weighted average price is. That's my level of support. So I am just looking to sell every rally that I can, intraday, swing. I went home short overnight. I had a trailed stop. Of course, it trailed me out. But I wish I was short right now. But the point is, I'll keep looking for rallies to get in short, and until I see 1942 trade and potentially that uptrend. And it's interesting how a lot of times those things will coincide. So I think the low 1940s is something you could look at. Now, that's an area where I not want to be long. So I want to say this too. You might see an oversold scenario come in, and all of a sudden you get oversold below 30. Let's move this down here, and you get to that. And that doesn't ultimately mean I want to be bullish now. What I also think that a lot of people will get in early on a reversal back, and I will wait and wait and wait and wait again, because I mean, who knows, equities might be at the trade I look at that point in time. But right now I am just very focused on selling rallies till we trade 1942 or this trend line, and watch from there. And who knows, we might get an acceleration even lower. And one thing I want to pull up is the 60-minute chart to help us with this. And why do I use the 60-minute chart? Number one is with gold, I'm not scalping it. I don't really scalp anything anymore. I try to just stay position wise, and I use Bollinger Bands, and I use a VWAP. Just really that simple. Okay. I'm not looking at anything else, because as Bollinger Bands are widening and we're staying below the VWAP, I'm just looking for rallies to sell. You could take this down to a 3-minute, a 5-minute. As long as we're below this today, which is really 1970, and the mouth of that Bollinger Band is open, I am looking to sell every single possible rally that I can. And stops always have to be, this is where you may want to start using like standard deviation bands or something around it. I actually could pull some of those up just to see what they look like on here. And I would probably take the time frame down a little bit, because it's just a little bit too wide for me. You go down here, and I got the standard deviation bands, and I'm probably just going to use one standard deviation band. Let's see here. Why am I losing my place right now? But the bottom line is, you know what I'm saying. When you look at these, you're going to probably want to use something to guide yourself and have a little bit of a stop around that VWAP. You never want to put it just above it. You could use one standard deviation and probably use it on a shorter time frame. I wouldn't use that one there anyway. So that's just what I'm looking at. I'm looking at from daily to 60-minute, I'm taking it down in time frame, and I'm just trying to stay positioned in one direction. I think that too many people try to look for too many support or resistance areas, too many turns in the market. Like I just want to be short. I mean, I want to look for a rally. I want to wait to sell it. That's it. I mean, I'm not thinking too much, and thinking too much, it hurts your complexion, Tom. It hurts you. You get all these grays. I don't need that.
Well, it looks like you haven't been thinking too much then, Anthony. You look great.
Yeah, I'm not the smartest tool in the shed. I'll tell you that.
No, we won't say that. It might be a good transition to the Ask DYE segment because I know
Yeah.
the question this week is a little bit related to what we just talked about. The question this week is from Rob Data Warrior, and the question is, I'm not going to repeat the whole question, but I'll and my question is, instead of using middle Bollinger Bands, do you find it better to use VWAP? So I think I know the answer, but I'll let you answer it.
It's such a great question because it goes back to thinking outside the box, right? I think that so many people think to use standard indicators in their standard settings. And so many people are looking for or buying from other people all these other different indicators, and they're looking for the indicator that's going to give them the path to prosperity, right? And at the end of the day, all I think, all it comes down to is how you use indicators and what is your mindset? How do you want to execute a trade? How do you want to execute a trade in? How do you want to execute a trade out? And the reason why I like Bollinger Bands without the middle Bollinger Band is because I don't need an additional thing telling me what the middle of the Bollinger Band is. It's not really giving me any details and telling me how to execute a trade, some may argue. I like a VWAP because if we stay below the volume weighted average price, that might get a lot closer to the bottom Bollinger Band. That might give me a greater opportunity to come in. So like if you go back to the chart right now, let's just look at that for a quick second. Look at what happens in weak markets. In weak markets, when you look at the chart, you have the middle Bollinger Band, or you have the VWAP hugging the bottom part of the chart. And you see that right here, right? So it's actually on the lower third, maybe even the lower quarter, right? Whatever it is. And so that is telling me it's tighter to the bottom Bollinger Band, like you've seen here. It's a stronger downtrend, right? Versus waiting for that middle Bollinger Band test or using that as a guide. This is a more accurate guide. To each his own, but that's, why I like to use it. If the volume weighted average price is way up there, let's just say it was at 1985, I'd be like, whoa, man. If I was short, I would probably be looking to cover because there is a really probably good probability that they probably at least come back a little bit, maybe not all the way, but it's so far away that you're like, wow, look at 1970s, the VWAP. That's only $12 in gold. That's nothing. That's a sneeze. This thing blips up to 1970. So you're in this tightish range. And so I have a much better opportunity to manage risk with this as a guide versus a middle Bollinger Band, which would be, let's say, 55 to 2000. I mean, would be probably, what would it be? So you'd have 40s, you'd have 50 points, 25. It would be probably around 80 if I had a guess. So there you go. In this perfect scenario, that's just too much for me to manage risk. I'd be waiting forever for a rally to sell in gold. I'd never get.
That's a great answer, and I agree. You're closer to the price with the VWAP, and when you're in a trending market too, right? And you're hugging the bands like you are. That middle Bollinger Band is way far away. Thanks for that. And if you want to ask a question for Anthony for another show, just type on Twitter, use hashtag AskDYE, use @NinjaTrader in the tweet. If you're in the US and you follow NinjaTrader, we'll send you something nice. But I know we have a little bit more business to take care of, Anthony.
Yeah, if we could show the screen again, I want to talk about this. I think this is going to be awesome. It's funny that I'm actually in a time where I'm talking about gold a lot, and actually CME is running a challenge on gold that's going to be from June 4th to June 9th. And they're actually giving away gold. If you look at our grand prize winner for the first place of the trading challenge will be a gold bar. Second and third place will receive cash prizes. You could register the link if you're on my YouTube channel. You could see that there. I'm also going to be putting tweets out for this. I mean, you have nothing to risk doing this. You go in, you learn to trade about gold, take some of the strategies that I have. You're trading in a sim environment. And who knows, if you win a gold bar, trading the strategy that I talked about, don't forget about a guy. Maybe I don't know, maybe melt it down for a little, ring or something for me. Nothing crazy.
I love it. I love it. That's a great contest idea. The prize of a gold bar is really, really enticing. So yeah, where can they find out about it? They can find out about it through your website.
Yeah, you can probably go to anthonycrudele.com or just go to Anthony Crudele on Twitter or YouTube. I actually, for today's show, it should be a link, should be in the description, and I'll be posting more about it on Twitter. And of course, you could probably check it out just by whether Googling it. But yeah, I definitely will be putting links out for it, and you can find them in my description page. And one last thing of business before I know we got to go, we're on time. In 30 minutes, I'm going to be on the Place Your Trades Network talking about using event contracts for gold and how I'll be trading that. I'll be trading them live. Hopefully there's some trades. Who knows at this point, we're going to keep going down. I might be getting long some calls at that point. We might be so oversold, but it is an interesting concept. I do use NinjaTrader also for that as well. Like I said, I'll be trading live on the Place Your Trades Network in 30 minutes, trading event contracts for gold. And I'll be really taking it down to a much shorter term, looking for just for today's move towards the last hour or so, really, in gold. A couple hours, I should say, and that. So you can check that out on the Place Your Trades network.
Awesome. It's Gold Thursday here today on NinjaTrader. Thanks for coming back, Anthony. I hope you were well rested from last week, and we'll do this again next week. But thanks again for coming.
Thank you, everybody. See you.
And join us at the end of the day. Bars closing. I'll be hosting that. In the meantime, have a great trading day. We'll see you later.